10-month lows coming in for the Indian rupee, and the pressure points are coming in from the domestic as well as the international markets. In the Indian markets, it's a strong US dollar demand coming in for the defense-related payments. The month-end demand also coming in from oil refiners putting pressure. If you look at the one-year forwards, that's at a 3.5 rupees going on in for the currency. The jump up in the crude prices also is putting pressure. But the major point would be the GDP numbers coming in on Friday, and that would give you further direction for the Indian rupee. That's about the domestic markets. In the international markets, you have seen the US dollar gain up after the strong US economic data coming in. You also have seen Asian currencies decline. If you look at the Australian dollar, that one is trading at a 19-month lows. The euro also has declined after ECB officials said that they are okay with the Europe interest rates going into negative. So all of that really is putting pressure on the Indian rupee as well. Going forward, the bankers are working with a range of 55.20 on the lower side to 56.5 on the higher side for coming few sessions.
Okay, thanks very much, Manisha, for giving us all of those details. 56.20 for the rupee against the greenback. Anant Narayan, co-head of wholesale banking South Asia at Standard Chartered Bank, now joins in to discuss the macros in further detail. Let's talk about the rupee then, and of course it's back at those levels of 56 against the US dollar, and it's largely attributed to the appreciation of the American currency against some of the other currencies overseas. What do you think is going to be the level to watch out for, and are we going to sustain at these levels?
Well, the momentum of the weakness has been pretty strong over the last few sessions, and that is worrisome. Frankly, a lot of players, including myself, expected 56 to hold. The fact that it's broken through as it has is a sign of worry. Yes, a lot of it is due to dollar strength globally. The fact that we've seen a raft of good news come out from the US, the strength against yen, the strength against euro now, is sort of percolating onto India as well. Having said that, the rupee has depreciated even faster than the other currencies has, and that is a worrisome sign. I think it's a bit of an asymmetry, really. When the rupee strengthens, as it did a few months back, we actually had possibly the RBI come in and mop up extra dollars, which sort of limited the bottom to dollar rupee. We don't seem to have that kind of a ceiling as yet available when things start to move the other side. I think broadly, when we saw the March data come out very positive, when we saw commodity prices, particularly oil and gold, come off 2-3 months back, a few players probably went in with a long rupee position. That's being unwound in the last few sessions as we see dollar strength globally and a bit of nervousness come back into the markets. Medium term, I think 57 should hold. The prospects for India at a macro level still seem okay. Exports should go up going forward. Commodity prices are still behaving themselves even though they are volatile within the range. FDI flows anecdotally look promising over the next couple of months. You know, you have Unilever, you have Bharti, etc., which is due to come in. FII flows, particularly on the debt side, seem robust as well. So all in all, it seems as if there is no reason for actual panic as yet, but the momentum is pretty strong. So we will see volatility over the next few sessions.
It seems from your answer that you believe that fundamentally things can't get too worse from here. The question really is also that what does the Reserve Bank do? Because there have been murmurings about the RBI intervening, one in case of extreme volatility, but two, even though it's unsaid, just the kind of fall would probably prompt the Reserve Bank to maybe step in a bit to stem the fall really. Do you think that will happen if indeed we touch closer to the 57 levels, assuming we go there?
Well, I'm a biased player in that respect, and I have a biased view there. I think, listen, RBI has consistently said that they're not worried about specific levels, that they are worried about actual volatility and the size of the volatility rather than specific levels. So, 56, 57, these are levels the market watches. I don't think the RBI quite sees it that way. Having said that, I think there is a case for the RBI to temper the move. If you look at the overall balance of payments for the country, whether it was last year or for that matter for this fiscal year, I don't think it's a large dollar negative. In fact, we are projecting a $10 billion surplus in terms of balance of payments. So there is a need for some kind of stabilization on both sides. I think RBI has done that in the past when rupee was appreciating in terms of mopping up dollars. Probably makes sense to loosen up the purse strings a bit when the volatility goes to the other side as well. So yes, I think RBI should come in at 57, but who's there to second guess what RBI will actually do? In terms of the macro part, you mentioned there aren't any negatives as such. There are a couple of negatives, to be honest. One is, of course, we're coming closer to the political silly season of elections, and that's always an uncertain time for India. And the second is, when it comes to the actual growth story in India, there's still question marks in terms of the infra investments, and the micro level data isn't looking too hot as of now. One wishes that the CCI would actually result in some large infrastructure projects actually being declogged, and therefore the path being cleared for the growth story to come back into India. Until these two remain in, sort of unsorted or on the anvil, we will see some uncertainty on the macro front as well.
And what about the bond prices? You mentioned that there could be a 25 bips cut, despite the fact that the RBI had sounded that further rate cuts would be difficult. I'm sure things have changed between now and then, but the question is what happens to the bond prices as a result of that? You think all of the RBI's actions or the belief of a 25 bips has been priced in already?
25 basis points cut, I think, is pretty much priced in. If we don't get a cut in June, we will see a sell-off in bonds. A few more things. One is, of course, the current bout of dollar-rupee volatility does not help. The RBI has repeatedly said that current account deficit is something that they watch closely when looking at monetary policy. A weak rupee and prospects of volatility will make them more circumspect when it comes to rate cuts. Having said that, the fact that there has been this relaxation on the withholding tax front, there is a possibility that the FI limit for Gavi's government bonds is increased even further. There has been some enthusiastic bidding in the last couple of auctions for debt limits. It does look like there is a significant demand coming through for bonds, both from the domestic mutual fund segment as well as from the FI segment. So, it does look like it will remain in a range, the old 10-year bond, maybe in a 725, 740 kind of range. One question mark which remains is OMOs and whether the RBI will do more open market operations in terms of actually buying up bonds. They have eased up on that for the time being, but one is hoping that they come back and sort of support bond prices with that action.
Great. Anand, it's always good having you and your views, of course. Thanks so much for clarifying it for our viewers, and thanks for taking the time out and being with us.